first thing we're going to talk about is about how to calculate the return on equity of a piece of property inside of one of our portfolios. So that's called the ROE, the return on equity. And guys, this is a new term for me. I'm learning it as you're learning it. This is not a term that I've actually used. Although we've done this kind of calculation for years, we just didn't have that return on equity as symbol that we use, the ROE, the ROE. So the ROE is a key metric that shows how efficiently your equity is being utilized to generate returns. So to calculate your ROE or your ROE, you divide the property's net income by the equity invested in the property. A high ROE indicates a good return relative to the equity invested. And so in this case, what we're talking about is how much cash do you have invested in the property. There's another term that we're going to get into later in the video where we're going to talk about added equity or the appreciated equity. So when we buy something, generally speaking, we're going to try and buy it at a price that we have some equity when we first buy it. And then we're going to try to force more equity by doing what we call value add real estate investing. So if you watch our channel, you know that we like to buy like nastiest, dirtiest, ugliest freaking thing that we can find in the very best area that we can be in, right? And that's a formula that we use again and again. Find something that's dilapidated. Find something that has no use. Find something that doesn't have any revenues coming in. Buy it at a very low valuation, and hopefully we have some instant equity by buying it at a very good deal. And then we're going to go in and we're going to invest a whole bunch of money into it, and we're going to bring it up to its highest and best use, and we're going to force more equity. So in this first case, though, we are talking about the invested dollars. So that invested dollars would be the purchase price, the renovation costs, potentially the holding costs would be in there, the taxes, the insurance, all of our costs, kind of the outgoing flow of our money. We're going to compile that all up into a list, and we're going to say we got $100,000 to purchase it, $100,000 to renovate it, and $50,000 for holding costs, and now we're in it for $250,000, let's say, all in. And now it's throwing off cash flow. Now we've got it up to its highest and best use, and it's throwing off cash flow, and we want to look at what's our return on equity. Our good return on equity for us is something that's going to be above 12%. Once we get above 20%, we're super excited about that. I mean, that's a phenomenal return. And you get above 25%, we start calling those things like the deal of a lifetime. Guys on the island of Puerto Rico inside of hospitality plays, it's not uncommon for us to get up into 30 or 40%. And that's kind of like this realm where people start to not even believe that you can do it. And I get it. And right. So this is what we're looking at. And so we're calculating that. Let's say we've got $250,000 of cash invested in it. And in order for us to get a 20% return, which would be phenomenal for us, we need for the thing to throw off $50,000 a year. And so we can do that inside of small hotels. We can do that sometimes inside of small multifamily properties. We're going to say that we're all in for $250,000 and we have this fictional $50,000 of revenue per year. That's a 20% ROE, return on equity. And that would be phenomenal. That's what we're shooting for. That's what we're aiming for. That's the benchmark that we want to get to. Number 2, assess cash flow. So we're going to analyze the cash flow generated by each property in the portfolio. And the things that we're going to consider in this are the factors like rental income, operating expense, maintenance costs, property management fees, and vacancy rates. So a positive cash flow is essential for a healthy rental portfolio, and any good property manager is going to know this number. You're going to be able to assess your cash flow and know where you sit at any certain point in time. And in fact, because we're doing this is what we do and this is how we do it and talking about why, we use this assessment of cash flow on a weekly basis. Like, we're pretty fanatical about this. Adon and Dave and Robbie, we have had a meeting every Monday for the last year and a half to talk about the property that Adon was managing, the Surfing Turtle. And we would talk about, hey, how's our cash flow? What does it look like? And Adon would say, for instance, we had really good bookings this month and we're going to bring in X amount of dollars. And then I would immediately follow up with the question, okay, great, what were our expenses? And then Dave would jump in and say, yeah, well, we brought in $25,000 this month and that's phenomenal, but our expenses were a little bit high because we had a toilet backup and we had to send out a plumber, and we had a fuse blow, and we had to send out an electrician. And we're analyzing this stuff like on the fly in real time, trying to figure out how we can get our positive cash flow to be more positive. So we're trying to identify where are the weaknesses, why do we have these expenses, and what can we do to cut down on that, and where can we drive revenues to go up higher. So this is just kind of looking behind the curtains of a real estate investor who's investing in these kind of projects, and what we use these terms for and what we're looking for when we're doing it. So guys, I hope that I'm clear on this. It's after 7 o'clock. I sometimes fall apart when we're shooting these videos like this, and I may have on this one, but I think I got it. I think I nailed it for you. If you like that, leave me a comment. Let me know I'm doing okay. So number 3, guys, we're talking about how to evaluate our rental portfolio, and we're talking about doing it over a few different portfolios that we manage in real time and giving you a look behind the curtain. So number 3, when we're evaluating the performance of our rental portfolios, is evaluate the appreciation. Over time, I say all the time, if you watch our YouTube channel, I tell you that if you are a value-add real estate investor who buys for cash flow and holds on to real estate for a long period of time, you're going to hit a grand slam home run just about every damn time. And so we are constantly in real time looking at how much appreciation have we had on a piece of property inside of the portfolio. So let's say going back to the example that I used earlier in this, we've got a property that we invested $250,000 in. We bought it for 100, we renovated it for 100, we spent another 50 in holding costs before we got to cash flow positive. So we've got $250,000 stuck in it. And at the time that we did that, it had one valuation. Let's say it was worth $300,000 and we had $250,000 in it, and we had some positive cash flow. And now what we're looking at for this evaluation of appreciation is what's it worth today? And we're going to assume that 5 years has gone by and the property has appreciated at 10% a year. Maybe that's too high, maybe that's pie in the sky stuff, but actually on the island of Puerto Rico, that's probably low. So what we're looking for with this calculation is, should we keep it and continue to make the cash flow, or has it appreciated so much that maybe it no longer makes sense for us to keep it in its current state? And it might be that we need to sell it to the next guy and let them invest new dollars and get a return on their dollars. Or we may want to take this asset and go to the bank and pull out some money so that we can unlock some of that capital. So this is stuff that we're thinking about. This is stuff that we're evaluating again and again. We do this like every single week of the year. And then towards the end of the year or the start of the year, we will look at the portfolio as a whole and we'll try and determine some kind of stuff that's not performing as well. And we'll usually sell some of the lower performing stuff. And we'll also be looking at some stuff that's performing really well, but it's appreciated so much that we either need to borrow money against it and pull out money so that we can buy the next thing, or we sell it. So that's how we determine whether or not we're going to keep something or sell something. Number 4, the 4th thing that we consider when we're thinking about should we keep it, should we sell it? We consider the market conditions. So what does that mean? We're going to evaluate in real time what is the current real estate market conditions in an area where our properties are located. So we're taking in factors such as, is there a demand for the properties that we have, or is there no demand? How about the supply? Are there a lot of things that look like what we've got on the market, or is there nothing that looks like what we've got on the market? We're looking at rental trends. We're looking at economic indicators. So that can influence a decision for us to whether or not we're going to keep something or we're going to sell something. So should we hold on to it or should we sell it? When we're thinking about market conditions, right now in Florida, we have a rental portfolio that has had recent massive increase in the valuation. And I'm talking about, we've owned several things inside of the portfolio for coming up on 15 years. And so from the price that we bought them at to the price that they're worth today, we're talking about like a 10x. So the thought is, are we making enough money on those rentals that we should continue to hold on to these properties, or should we sell? So this is something that we think about all the time. Again, we're giving you a look at what we do and we talk about why we do it. So what might help us is that if we have a rental house in Orlando, Florida, and the conditions for us to sell it there are tremendously good, then we would put that house on the market and sell it so that we could redeploy the dollars here on the island of Puerto Rico, let's say into a hospitality play. Now, why would we do that? Because we know that right now the hospitality play has much higher upside. We've already captured this massive upside in the portfolio in Florida, and the rents can't keep up to the valuation. So if we liquidate a portion of that asset and then bring the money over to the island of Puerto Rico, we can get a better return and we can continue growing that equity. The likelihood of massive appreciation right now in 2024 on a single family house in Orlando, Florida, isn't as good as the likelihood of appreciation on something that cost about the same, but let's say it's a small guest house on the island of Puerto Rico. So that's what we're thinking about, why we would keep something versus sell something. Number 5, the 5th thing that we're going to look at in real time throughout the portfolios is how are we doing with our debt levels? So for us as PR consultants, or my company back home in Florida, FP Consultants, we don't keep a lot of debt. So when we look at this, generally speaking, I can look at this and tell you that we don't have very much debt. A few years ago, I was being told by some people that I really like and that I trust that I needed to borrow more money. And I was a little bit pig-headed about it. And we borrowed some money. But now sitting in 2024, looking back to the conversations I was having in 2020 and 2021, when my friend Jeff Murphy was telling me, Robbie, if you go borrow a bunch of money, you're going to feel like you're rich. And I didn't do it, and I wish that I had. So this is an important calculation that I wish that I'd paid more attention to 3 or 4 years ago when interest rates were extremely low. So the idea is to assess the debt levels on each property by calculating the debt to equity ratio. High levels of debt could increase risk and affect your decision to hold or to sell. Well, since we don't have any debt, we could have borrowed a safe amount of money and still had plenty of cash flow and been completely safe, be able to sleep at night, but we could have had a pile of cash that we could be reinvesting. So I missed the boat there. So this is something that you guys, if you watch this YouTube, I give it to you straight. I tell you the good, the bad, and the ugly. I was told by my friend Jeff, hey, Robbie, it's time to borrow money. It's at all-time lows. And we talked about it probably over the course of a couple of years, 2 or 3 different times. And I mostly ignored the advice that Jeff gave me, and now I sort of regret it. So I generally regret the things that I don't do, not the things that I do. And this is a case of that. I wish that back in 2020, 2021, we had borrowed a whole bunch of money at 3% or 4%, because now that money costs twice that. And we're probably not going, even if we did go to borrow some money, we wouldn't borrow as much, and it wouldn't be as safe to borrow as much.